Have you ever looked at trading and just thought, wow, day trading seems way too intense? Being glued to a screen all day, the stress of it all. Well, what if I told you there's another way? An alternative that's actually perfect for busy people. It's called swing trading. And today, we're going to break down exactly how you can get started. So here's the game plan. First, we'll talk about why swing trading might just be the perfect fit for your lifestyle. Then we'll get you set up with an essential toolkit. Don't worry, it's just a few simple indicators. After that, we'll dive into the really fun stuff, 3 key chart patterns that you can start hunting for. And finally, we'll tie it all together so you can see step by step how to execute your very first trade. Okay, first things first, let's talk about finding a trading style that doesn't completely take over your life. So many people get excited about the markets, they jump into day trading, and they burn out fast. It's just a relentless pace, and that is the exact problem that swing trading is designed to solve. I mean, the difference here is like night and day. Day trading is all about speed, it's super emotional, and it can be incredibly unforgiving. You're in and out of trades in minutes, maybe a few hours. But swing trading, it just slows everything way down. You're holding positions for days, sometimes weeks, or even months. That alone makes it so much less stressful and way more flexible. And this quote just nails it. If you're juggling a demanding job, a family, a life, you just can't be staring at charts all day. Swing trading gives you that freedom back. You can do your analysis in the evening, maybe on the weekend, place your trades, and then just let them play out without constant babysitting. All right, so hopefully you're on board with the why. Now let's get into the how. It's time to build your toolkit. And again, we're not going to overcomplicate things here. We're going to focus on just a few simple but really powerful tools to help you start reading the market's language. First up, we need to be looking at the right map. For swing trading, that means you have to zoom out. Forget those chaotic 1-minute or 5-minute charts. Your new home is going to be the daily and the weekly charts. This helps you see the bigger picture, see the forest for the trees, and tune out all that distracting short-term noise. Now for your tools. Believe it or not, we're going to build our entire strategy around just 3 core indicators. That's it. We've got the 8 EMA, the 200 SMA, and good old volume. It sounds simple, I know, but trust me, when you use them together, they are incredibly effective. So what's this 8 EMA thing? Just think of it as your short-term momentum guide. It's super responsive to what the price is doing right now. When a stock is in a really strong uptrend, you'll often see the price almost ride this line like a wave. And when it pulls back, touches that line, and then bounces, well, that can be a fantastic place to look for an entry. Next up is the 200 simple moving average. I want you to think of this as the big important line in the sand. It tells you the long-term story. And the rule of thumb is simple. If a stock is trading above this line, the big institutions consider it to be bullish or healthy. If it's below, it's bearish. For our strategy, we want to be fishing for opportunities in that bullish pond. And finally, we have volume. You can think of volume as the fuel behind any price move. If a stock breaks out past a key level, you absolutely want to see a big spike in volume. It's the market confirming the move, saying, yes, we believe in this. A breakout on low, quiet volume is suspicious, but a breakout on huge volume, now that's what we're looking for. Okay, we've got our tools. Now let's put them into practice with a tactical playbook. We're going to look at 3 specific, repeatable chart patterns that you can start hunting for right away. But first, a really important rule here. The patterns we're about to discuss work best on larger, more established companies. We're talking about stocks with a market cap over $1 billion. This is crucial because we want to avoid the extreme, unpredictable volatility of very small, speculative stocks. Our first pattern is one of the most powerful out there, the daily gap up. This is when a stock opens for trading significantly higher than it closed the previous day, usually because of some great news. So what's the checklist for a high-quality gap up? Well, first, it needs to gap over a significant multi-month resistance level. Second, there has to be a real news catalyst behind it, like blockbuster earnings. And third, and this is key, we don't just buy it right at the open. Nope. We wait for it to pull back towards that 8 EMA we just talked about. Next up, we have the long-term downtrend break. This pattern can signal a major shift in character for a stock that has been beaten down and forgotten for a long time. What makes this pattern so powerful is the convergence of a few different signals. You're looking for the price to break above a long-term downtrend line. You want to see that break confirmed by a big spike in volume. And often, the absolute best setups happen when the stock also reclaims its 200 SMA at the same time. It's like all the signals are pointing in the same direction. Our final pattern is a bit more of a contrarian play, the oversold bounce. Here, we're looking to buy a good company right after it's had a sharp, short-term drop, often because the market overreacted to some bad news. Now, the key to this pattern is patience. You are not trying to catch a falling knife. We let the stock drop, we let it find a bottom, and then we wait for a clear sign of strength. And that sign is a definitive close back above the 8 EMA. That's our signal that buyers might just be stepping back into the game. All right, we have our tools and we have our patterns. Let's move to the final piece of the puzzle and see how this all comes together into an actionable plan for finding and executing a real trade. So how do you actually find these setups? You use a stock scanner. Now, while there are fancy paid scanners with real-time data, you absolutely do not need one to start. A free tool like Finviz is fantastic for beginners. And since we're looking at daily charts, a 15-minute data delay is perfectly fine for what we're doing. This slide puts it all together into a simple 3-step strategy you can use. Step 1, scan. Sometime midday, look for stocks that have gapped up more than 3% and are still holding strong. Step 2, analyze. Pull up the chart. Does it meet our criteria, breaking resistance above the 200 SMA, high volume? Check, check, and check. Step 3, execute. Enter on a pullback to the 8 EMA, set a clear stop loss, and have a plan to take your profits. So there you have it. A complete framework for getting started with swing trading, a way to engage with the markets that actually respects your time and reduces your stress. The only question left is, with these new tools and patterns in hand, what opportunities are you going to spot this week?